In this video, we're going to talk about the difference between actively managed and passively managed mutual funds. So actively managed mutual funds, the manager is trading stocks or bonds or whatever the securities are in the pool of investments. They're trading those on a regular basis, whereas the passively managed, maybe they're tracking an index or something, and so they're not trading stocks and securities and so forth regularly. So think about it this, if you passively manage, it's something like the S&P 500, and you tell the manager, look, I just want you to own all the stocks in the S&P 500 in an equally weighted portfolio. So that manager is not going around buying and selling things. They just buy what's in the S&P 500, and that's the end of it. They actively manage. Let's say that the manager decides, oh, you know what? I think that Microsoft is going to have a bad earnings announcement. I think we should ditch Microsoft stock. So they go and they sell Microsoft. So there's trading going on in the actively managed portfolio, where the passively managed portfolio or mutual fund, it's basically they're tracking an index or something. There's not a lot of stock trading going on. And this is going to affect the expense ratio. And there's a couple of different reasons why. And one is in terms of the compensation for the manager. So if the manager is being compensated for trading, right, for their trading savvy, their trading abilities, they're having to do a lot of research, they have a lot of pressure, they have to make decisions. They're trying to basically beat the market, right? That's why you have them trading instead of just investing in an index fund like the S&P 500 or something. So they're going to want to be compensated. So there's going to be higher compensation. So the manager is going to have higher compensation for doing that trading, rather than somebody who's in a passively managed fund. They just buy the portfolio that's in the S&P 500 or some index, and then that's it, right? So, but it's not just in terms of the manager's compensation. It's also going to affect the expense ratio in terms of trading costs. Because if the manager is constantly turning over the portfolio with this actively traded manager is saying, look, we're constantly buying and selling new stocks, then you're going to have a lot more trading costs. And if you're just buying an index and you're just passively managing the fund, then trading costs are going to be really, really low. So you'll end up with something where the expense ratio for an actively managed fund might be something like 1.5% or even higher. Might be 1.5% of the assets that are being managed. Maybe the passively managed is something really low, like 0.25%. So it depends on the fund, but typically it's going to be a lot lower for a passively managed fund for these reasons here. But there's also an issue of risk, and that's historically only 20% of actively managed funds, only 20% have outperformed the market. Right, so when you say, well, why are we benchmarking against the market? Well, obviously, if you did a passively managed mutual fund, you get a lower expense ratio, and you just get whatever the market return is, right? Like the S&P 500 return or whatever index you're in. So we want to benchmark to see whether it's worth it with actively managed. We want to say, okay, are they beating the market? Are they beating what you could get if you just went with a passively managed index fund? So only 20% of the actively managed portfolio or mutual funds are doing that. So the managers, only 20% of the time, are able to beat what's going on over here. So you might be wondering now, okay, well, why would anyone choose an actively managed fund? I mean, we have a higher expense ratio, and only 20% of the time do we even get a higher return than this, than what we would have got if we just had an index fund or something. And even then, just because it has a higher return than the market doesn't necessarily mean it's going to compensate for the extra fees that are being charged. So why would people do this? Well, the reason is that investors, for lack of a better term, I mean, they can be greedy, and I don't mean that in a negative sense, but they want to make higher returns, right? They want to say, hey, I want the maximum return. I worked hard for this money, and I don't want to just accept what the market will give. I don't, the market, let's say, historically give you 10% or 11%, and they say, you know what, I really done my research, and I think that this manager over here and this fund, he or she knows what they're doing, and they can get a return of 17%. And so they think that that fund is going to be part of the 20% that does beat the market, right? So it's like they're not sitting there investing in this thinking, oh, this is going to be one of the 80% that just underperforms what the market does. They think they're going to be in that 20%, and they're wanting that extra return, and they're willing to take on additional risk. And then, of course, obviously in the media, we always have things where we're looking at, oh, well, there's this hot fund. There's this hot new fund that has this return of 17% or 25%. It's hot. You should get into this fund. But you really want to look at how the fund is done over 5, 10, or 15 years. Right? You want to look at the long haul, because any fund for just 1 year, let's say that you had some fund that had some 30% return in 1 year. And you say, hey, you know what, I should really go and invest in that fund. But maybe that fund is a sector fund that is just invested in technology stocks, and technology stocks just had a really great year. So that doesn't necessarily mean that manager over here in the actively managed portfolio is that much smarter than anybody else. They just happen to be in a situation where the stars were aligned and tech stocks did well. Tech stocks could just fumble the ball next year and end up losing money. And then that hot portfolio manager who looked great yesterday doesn't look so hot the next year. So obviously we want to look at past returns, but you really want to bear in mind, you want to look at the long haul. You want to look at 5, 10, 15 years, how these funds are doing, and just bear in mind that most of the time you end up with a better return with just a passively managed mutual fund or an index fund, although occasionally you could end up in that 20% where you